Good afternoon, everyone. It's my honor to moderate the family office panel session today, and we will be discussing how far it has evolved over the years. So we will start off with introducing ourselves, and I will start by myself. Okay. So my name is Phoebe, and I run a fund called the Art of Capital, and we primarily focus on cross-border transaction between the US, Australia, and China. Kevin, your turn.
Hi, I'm Kevin Shen. I'm an investment director at Skyfield. We're a single family office. The family has interest in real estate in Australia and Asia, and I look after the non-direct real estate investments. So that includes listed investments, and on the unlisted side, we have some venture investments and private credit.
Listening on? All right. Ken Shaw. I'm a recovering CEO and entrepreneur, and now running a third-generation family office.
Hi, I'm Bruce Davey. I run, again, a fairly simple family office. The dominant thing we do is algorithmic trading of equities and derivatives, and you all heard about the property side of our business just before.
Hi everyone, my name's Ed Carroll. I run a firm called MHC Digital Group. We're an investment bank for digital assets. We've got a markets platform which facilitates buying and selling and custody of crypto and crypto derivatives, and we also have a funds platform as well.
Today we're going to cover a broad range of questions based on different expertise here today. So Kevin, I will start with you. Given your experience at Skyfield Capital, how have you seen family offices evolve over the years? Are they becoming more like institution investor, and what is actually driving this trend?
Yeah, look, I can probably give my view as a professional. I'm not part of the family. So I think two things that are driving family office investment trends are the amount of capital they have and the age of the family office in terms of generations. So first generation family office, so the business, so they're still operating in the business, tend to be pretty hands-on in investment decisions. They want to make investments that they feel not only provide returns but are impactful, and oftentimes in the area that they have an expertise in. As you go get into the later generations, you start to deploy more capital to get your returns. So that might be in forms of property or credit, or the children might have the finance background and might want to start a fund of some sort. And then the later generations, it becomes much more institutionalized. You look at portfolio allocation, correlation of investments, etc. And I think the other big theme I've seen is that access to good alternative investments and top managers is no longer really an issue for family office. I would say 10 or 15 years ago, to really get to invest in the very best managers globally, you needed to have 10, 20, 30 million minimum check sizes, be an endowment or insurance fund. But I think nowadays the GPs themselves are targeting family office capital. So a lot of them are talking to us directly. They're making investments available through wealth platforms. So some investments that were exclusive for institutional investors are now available to family offices from as small as $50,000 to $100,000 check sizes, but they also have bespoke products like separate managed accounts that start from 100 million. So in that way, family offices do have access to not only alternative investments, but some of the best alternative investment managers globally.
So based on your current investment theory, what are the top 3 sectors do you think that's highly favorable by family office at the moment?
I think every family office is different. It's cliche that once you've met a family office, you've met one family office. And I think the sophistication and also what the principals want to do. So generally there's a bucket that's the more safe, high-yielding assets. So that could be whether in the form of property or private credit. And private credit's had a bit of a golden age, if you will, getting very good returns for certain credits at pretty good risk. And then there's the other bucket where it's impactful, or they want to make multiples of returns, and those could be in venture, in private credit, whether private equity, whether through investment managers or directly. And I actually think the listed space is fairly well suited for family offices. You know, if you think about the goats of investing, Buffett and Munger, what they've taught us about being patient, long-term investors, be aligned with the management and not be greedy when others are fearful. Lots of institution fund managers cannot do that by the way they're set up, and they have to mark to market monthly, and they've got investors to answer to. Whereas family offices, by nature, long-term patient investors, and we can be quite flexible in terms of leaning into investment sectors that are out of favour but are still fundamentally sound. So I'll say those are the interesting areas.
In that case, how do you actually balance listed equities as opposed to private investment? Because there is a range of portfolios that you need to manage as well.
Good question. It's about focus. So, you know, a lot of my time is spent on the listed side. There's a huge universe of companies to invest in, but, you know, we don't need to invest in all of those companies, and we don't need to look at all of those companies. So I focus on the companies that I know and the sectors that I'm interested in. And then through the private investments, again, it's areas that I know. You know, I've worked in private credit myself. So in terms of private credit deals, I can get a pretty good read on deals that are already structured. And in other instances, you can just go through managers that you believe. So you're sort of leveraging your capital in terms of picking who you think the best managers are and letting them select the deals for you.
Okay. Well, Kent, you have been both sides of the table and raising capital as a founder and now working with Scale Out specifically. So how are family offices leveraging their operational expertise to add value to their direct investment at the moment?
I think I'm the only operator / sort of, as I said, recovering CEO up here. So I might address my comments sort of to that audience. By show of hands, who in the room's here to try and get money? Who's an entrepreneur or an operator looking to raise? Lots of you. Okay. Who in the room is a professional investor? Actually, you know, writes checks or works at a, okay? Probably don't want to self-identify, do you? You get mobbed. Who in the room's an advisor helping one of the first two buckets? Okay, cool. Well, I might address the 50% of you that are entrepreneurs trying to raise money. I think Kevin said something important, well, a bunch of things that are important. Here's the issue with family offices, and that's what Kevin said. If you meet 50 VCs, right, there's, like literally, you meet 50 venture capitalists, there's maybe 1.5 business models between them, right? They're all 10-year closed-end funds. They want, you know, they're writing checks between X and Y for companies of this size to that size. They're going to have 15 to 20 investments in a portfolio, blah, blah, blah. You meet 50 family offices, there's like 47 business models between them. That sucks as an entrepreneur, right? Trying to understand all of that. I'm a software engineer originally, and you know, in programming languages, we have a shared syntax, right? And it has the benefit that everybody there therefore has a shared mental model of how to write code. There's no such thing with family offices. And so I raised a bunch of money and would have had 100 term sheets plus. The very worst term sheets I ever got were from family offices. And I actually consummated a deal with the family office, one family office, and they were, oh my God, it was like having Dracula on my board. It was just a nightmare. So those are sort of the negative comments. Then I'll fast forward to where I am now, and I guess I'd like to think I'd be different to that. Kevin also said something really important, which is he likes to invest in stuff he knows. You know, you worked in private credit. And so, yeah, senior secured debt, great place to put money if you're allocating. But, you know, the best writers, they write what they know, you know. Jeffrey Archer's first novel was a vignette from his life. The best investors invest in what they know. So I think all of that is to say, if you're trying to raise money from family offices, you really got to do your research, get inside their heads, understand who you're dealing with, what motivates them. Are they the first generation entrepreneur who made the money? And by the way, they're the ones that you want to deal with, right? They're the ones, because that big negative I gave of the family office, all of them sort of being bespoke, is also their great strength. I advised on a deal with a family office where about 20 minutes into the pitch, the principal basically told the entrepreneur to stop talking and agreed to put in 1.5 million. The entrepreneur was asking for 250,000, right? So that's awesome when that happens, but that almost never happens. So with that huge preamble, I'll say when I'm looking at investments, I invest in what I know, right, which is B2B software. My father, he invests in what he knows, which is real estate. So those are the two asset classes that we play in. And that, I mean, that does, that works well for us. But yeah, I wanted to address the half of you who are here to get money.
But based on the family office portfolio structure, sometimes they do have quite a diversified portfolio here. So what would you advise family offices when they wanted to invest into a scale up? And what are the key factors do you think they should assess?
Yeah, so broadly the question is FOs looking to make direct investments. I'll stick to tech because it's what I know. And look, I advise sort of other families informally, sometimes formally. I'd say stay away from direct tech investments. Leave it to the pros, right? I think that's generally a good rule of thumb, because tech investing is hard, right? There's a reason why, there are the Sequoias of the world. It's hard, so the elite go and work at the best firms. And I would say it is like quintuply true right now. We're going through the biggest tech disruption probably in the history of modern technology, right? AI. AI is by far the most impactful tech we've seen in like the last 100 years. I'm going back to airplanes and cars, 120 years. Let's go back to 1900. And it's being adopted far faster than any other technology ever, right? Internet took 25 years to go from ARPANET to mass use. PC took from like 1981 to 1994 to go to mass use. AI got to 1 billion global users in 3 months, right? It is nuts. So if you think about what the internet and PCs did to investing, venture capital investing, some of you remember the dot-com bust. I graduated high school in 2000 and I had, believe it or not, I had a whole bunch of shares and got wiped out. Good lesson. But the internet bubble buggered up the entire investment world, right? Because it was too disruptive, too fast. Well, AI is much more disruptive and much faster. So the smart money is hanging back. The smart money is waiting, right? Wait for the dust to settle. Yeah, so nutting all that out. My advice to family offices would be stay away from direct tech investments right now. In general, allocate through the pros, through managers, or hire pros, like say Kevin here. And that's, I would say that's a good catechism generally, but super true at this moment in time, this AI moment we're having.
You mentioned about AI. How do you think that's impacting the family offices in terms of investment landscape?
It's just creating so much noise, right? So investors, the minute you sort of present yourself as an investor, you get mobbed, right? I get 1, 2, 3 emails or LinkedIns per day from people wanting to pitch me. And so that's already hard enough. And we're a small family office, right? With AI, the amount of noise and crap in the market has just, like, it's 10x'd, right? I'm somewhat of an expert on B2B software, and I'm confused. I've been doing this 25 years, and I mean, just for some context, like I built a B2B software company that was a Gartner Magic Quadrant leader. I had 200 employees, raised about 75 million Aussie and sold it. So I know something about this, and yet I'm absolutely stumped by this moment we're having. So yeah, my answer is I don't have an answer.
Okay. Well, now we're moving into a little bit more of the real estate focused topic here. In the recent years, alternative asset class have become increasingly popular due to market volatility. And it's been quite highly competitive. So we talk about the private credit funds and we talk about the real estate funds. And Bruce, we would like to talk a little bit more about the alternative investment here. For short-term real estate rental, they are becoming increasingly attractive to family office. And what do you think is driving this interest?
I think alternative investments of a lot of different kinds are quite a good match for family offices. I think the appeal of alternative investments to anybody is kind of sits there in the name, alternative. They're an alternative to something, and for them to ever get any investors, they've got to be a better alternative to somebody for that something. And usually that's the thing they're better on is return, but usually they have some catches, and I think family offices are a good match for those catches. The size, a lot of the alternative investment markets are niche, which means on the whole, they're on the small side for big institutions, but the complexity takes them out of the realm of smaller individual investors. So I think on size, they're a good match for family offices. They tend to be unlisted and therefore illiquid. And I think that the patience that Ken was referring to earlier of family offices is important there, because some alternative investments, look, some of them, but there's certainly private credit funds where you can get in and out pretty quickly, but there are other alternative investments where you're in that investment for 10, 15, 20 years. And I think family offices have the patience for that.
There has been quite a high yield for short-term rental funds. And I think that what is the operating challenges from your perspective in this fund?
Well, short-term rentals, the operating challenge, it's basically property management on steroids. Instead of needing to let a property, once every few years, while you let it, once a week, instead of getting maintenance done a few times a year, the customer base are the kind of, pretty fussy customer base, and so properties are getting maintenance on a regular basis and certainly cleaned on a regular basis. That's really the operational challenge, just a lot more.
So looking forward, how do you see the short-term rental market evolving in the next few years?
A few different aspects of this. I see it has been professionalising over the last 5 years, and that'll continue. When it started, it was all someone with a spare bedroom or someone with one place putting their own place there, but the operational challenges make that it just doesn't make sense. It needs an economy of scale, and so it has been gradually professionalising, and it'd be about 50-50 at the present moment, and that's going to continue. The regulatory regime around it has gone some of the way to becoming absolutely clear, but there's another few rounds in different jurisdictions to work out whether it's allowed and in what manner that it's allowed. I think they're the two big themes in the short term.
Okay, thank you. Edward, now we're moving into digital asset topic. So we get to see from different sides of the table, understanding how the family offices look into digital asset as well. So Edward, MHC is bridging traditional and digital assets. Are family offices actively incorporating digital asset into their portfolio?
Sorry, was the question how they're integrating it?
How are they integrating into it? Because I understand that digital asset has been quite a challenging thing.
Yeah, I think the issue with digital assets for family offices and kind of the more sophisticated ends of the spectrum, all the way up to institutions, has been that there's been a kind of lack of clarity on the regulation, which hasn't really given the green light until recently for them to start to allocate. What we've seen the last sort of 12, 18 months is significant progress on that front, both from the type of products, being the kind of ETFs that were approved in the US for Bitcoin and others 12 months ago, into kind of a lot more regulatory clarity the last sort of 3-4 months, and we expect that to play out a lot in the next 12 months. And what that really means is that there is a bit more clarity around this, how credible the asset class is, which gives more reason for people to allocate. Now, in terms of what we expect and what we sort of advocate for family offices, I mean, I would always, I mean, if we start with just kind of like a Bitcoin allocation, we're very, very firmly in favour of a Bitcoin allocation in any well-constructed portfolio. We don't think anything more than sort of like somewhere between 1% and 5%, but I think the opportunity to use what is a very liquid asset, being Bitcoin, with an increasingly sophisticated product set around that to manage the volatility, to manage the potential capital appreciation you might see in it. We firmly believe the thematic behind that specifically is a logical starting point for allocation. And I mean, our firm has specifically designed itself to facilitate that by way of allowing, you know, sophisticated investors, wholesale investors, to buy, sell, custody crypto and then crypto derivatives around that to kind of get that comfort. But I think that digital assets are very kind of broad-based kind of, it's a poorly defined asset class because people don't really know if you're talking about Bitcoin or meme coins. When I advocate for an allocation, I think the starting point should definitely be probably a focus on something like a Bitcoin. And as you get more sophisticated, you can look to allocate further down the spectrum. But I mean, kind of like to Ken's point, there comes a point where the level of complexity requires that you kind of do engage professionals who actually understand the technology, to understand the opportunity, to really help with the advice and the way you manage that allocation. And I think that it's very important to consider that when you're making those kind of investment decisions, because there is a lot of risk out there as well. And I think there's also a lack of trust. I guess just last point on that though as well is that this regulatory point I'm making is very important because really fundamentally what it comes down to is that when there is an increase in the regulatory oversight of these assets, it does not just give a green light for people to look to allocate to the asset, but it also requires that they find someone they trust to actually manage that allocation, whether that be, you know, to buy, sell and custody it, or to allocate for an investment purpose. And I think what we're trying to service really is that more sophisticated allocation and to be the trusted partner for that, because we really think there's an opportunity in the market to deliver that in Australia and throughout Asia.
Yeah, just want to jump on that. So Ed and I were talking about in the lobby that like the irony of the digital assets, the Bitcoins, right, is that like that was built, people who like Bitcoin have like an allergic reaction to regulation, right? The irony is, of course, that without regulation, big money won't flow into digital asset classes. So we need regulation. But I want to just make a comment about family offices. For those of you who are trying to wrap your heads around what is an FO and how do you approach them or work with them. FOs can buy Bitcoin, right? Because family offices, 50 family offices, 47 business models. There's far more flexibility. Think about, you know, Aware Super or the big, you know, the huge Australian super funds and instos, who are some of the biggest institutional investors in the world. They ain't going to write checks into Bitcoin and Ethereum and other digital classes until the regulation's there. The point I want to make, though, is family offices sort of, they're a class unto themselves. We can operate like retail investors. We can buy Bitcoin. We can go into alternative assets like short-term rental funds. We can go into private credit. We can do senior secured direct credit deals ourselves. That's actually a really lucrative, you know, sort of model to put money into. But the point I'm making is if you're trying to wrap your head around FOs, it's really about the human being who created that wealth. And that person could be dead, by the way. You know, but it is a man-on-man sport when you're dealing with family offices. Person on person.
Yeah, just wanted to echo that point. I think, you know, everyone talks about, I think there's a lot of talk about data-driven, you know, returns, etc. I think family office, some of them are more, I guess, taste-driven rather than data-driven. So if you ask...
Cowboys.
Well, if you ask certain family offices what your required return is, you might not get an answer because it's not an institution where they need 5% and 10% of this bucket to pay for certain things. There's a different motive to just pure financial returns to some of the family offices. So this is why, you know, it's a lot relationship driven in terms of the deal you look at, what interests the family, and, you know, on the listed side where the market's huge, you only need to invest in a number of companies. You don't need to invest in all of them.
I'd also just add that, like, there is a kind of we separately run a traditional alternative asset management platform as well as a sister company to MHC Digital Group. So we have a lot of experience at the family offices as well. And I guess one of my observations, and you guys will have a better view of this being family office guys yourselves, but Some family offices are investors and others are allocators, and some are some hybrid of that. And generally, I mean, you're seeing the same thing at the institutional end of the spectrum with the superannuation funds doing a lot more direct stuff. But at the family office level as well, often what you find is that there'll be, some of them will directly invest in things, some of them will allocate to a manager to manage that investment for them, and some of them will have, you know, co-investment rights with the manager.
Yep.
So what you find is that you may want to you want to know what they're doing, what their interests are, where they're going to directly allocate. But you also want to know who they're allocating through, because if you can speak to who they're allocating through, you may actually amplify the amount of capital you can get out of any specific fundraising objective, because you go to the manager who, no doubt, a lot of the family offices may have actual co-investment rights with, and then you can probably raise more capital through that.
That's like secret black art knowledge, right? Finding out who the Meyer family allocates to and co-invests with, never going to happen. You know, I don't know. I reckon that's hard.
Yeah. I think generations, right? If you know this to the entrepreneurs who want to raise capital, you know, how new a family office is and how new maybe the chief investment office is also determines if they're more likely to talk to you. If family office has been in operation for a while or chief investment office has been in that space for a while, they normally know who to talk to or what type of investment they are. They get a lot of inbound inquiries and can't return all of them, so they're sort of active in looking at, I want this manager or I want this investment. But if it's something new to that seat, they're more receptive to talking to everyone or a lot more people in the market to kind of calibrate where they want to invest in. And then once in that seat for a few years and they've made a bunch of allocations, it's a lot harder to try and to get them to look at new stuff.
But like the longer a family office exists and the more successful it is, the more it looks like a traditional fund, right? So let's stick with Aussie entrepreneurs. Greg Clark, right? Queensland boy. I'm a Queenslander. Was CEO of Bluecoat, which you probably haven't heard of, but then CEO of Symantec, right? Max Norton. Now he is an investor, but his family office is better known as Crosspoint Capital, a fully structured private equity firm with a raft of analysts and investment directors. Let's go closer to home. The Gateway Building, 2 blocks over, my old firm, Potential Capital. That's essentially a family office. It's a multi-family office of Tim Reed and Andrew Gray, right? $1 billion fund now, but lion's share of the seed capital to FOs. You know, there's like 30 people who work at Potentia, right? So the more successful, at least in tech investing, the more successful FOs are, and the less sort of control the founders like the Jerry Harveys or the Fatty Palmers, you know, have over check writing, the more like an institution it becomes. And if it walks like a duck, quacks like a duck, you know, it's a duck. So, like the Meyer family, you may as well think of them as a PE fund. Yeah. My 2 cents.
Well, I believe that the audience here would love to know what are the things that you guys could advise, you know, as a portfolio companies. What are the things that you can approach family offices when you seek for investment? In a few words, what would be your advice to your audience group if they are seeking investment as a portfolio company?
I'll jump in. A warm introduction from a trusted person is the only way to talk to most family offices, right? VCs, they're structured. They have a funnel. You can call, an associate will have a coffee with you. Not my experience in FO land. Yeah, warm introduction, so valuable.
Kevin?
Yeah, I'd echo that. The reason, depends on the family office. If there's something like a Potential, it's not really a family office, it's more like a fund. So
no, it started as one and then is now absolutely a fund.
Sure.
Yeah.
So, you know, a lot of family offices are not set up to do deep due diligence on multiple deals, to have introduction coffees all the time, whereas funds are set up that way. So you know, we have to be very selective in where we focus our time and attention. You know, all of the deals we've done is through warm introductions or a trusted source, and it acts as a filter for us because, you know, we need to, there's a lot of things we need to cover, right, unfortunately.
Well, Bruce, what would be your advice based on your personal experience running the ReadySet short-term rental fund?
I think the other thing I'd say is family offices have kind of verticals or areas that they're interested in. So warm introduction, or put yourself in front of people from a family office that have an interest in your area and work out who they are first.
Ed?
In my experience, it's try your best to do their job for them. Provide like the most well-formed investment paper for them. Make sure that all the T's have been crossed and I's have been, you want to make sure that everything's done, and basically provide a well-structured, sophisticated investment paper, have the thesis sorted, understand the risks and sell the story. But obviously, like, not every family office wants to allocate to everything. So you have to be very conscious of what they like and then tell them what they want to hear.
And shameless plug for Steve and his businesses, exhibit an event like this because we come to these. And if you can't afford that, get on Capital HQ, build a sick profile on there so we can find you, right? Yeah. And if you don't know Steve, go introduce yourself to him. He runs this event, so.
Yeah, I'd echo that. And in terms of, I talked about access is no longer an issue, and also social media has made access much easier. So if you're a subject expert and you have a presence on X, or you're on a very well-known podcast, then people reach out to you. I've certainly reached out to fund managers in the US based off an interview I've heard or something that they've tweeted. So that's a good way to leverage your exposure through social media platforms.
Okay, thank you everyone. That has been a very insightful night.
Thank you, Phoebe.
Thank you.